You meet two people at the same dinner party. Same city, same rough net worth, call it 20 million each. One of them has a family office. The other one has never heard the term used seriously in a conversation that applied to him. And here's the part that should bother you. They might both be right. That's the thing nobody explains when they throw the phrase around. Family office gets used the way people use the word investment, as if it means one specific thing, a building somewhere with your name on the door and a staff of 12 who manage your money while you sleep. That version exists. It's also the version that requires somewhere north of 100 million just to justify the overhead without making your accountant physically wince. But that's not the whole ladder. That's just the top rung, and most people never learn what the rungs below it look like or when they actually need to start climbing. So start here. A family office is not an investment product. It is not a fund. It is not a building. Strip away the mythology and what you're left with is a system. A coordinated, intentional system for three things: managing money, managing the life that money creates, and managing the risks that both of those things attract. Investing is one piece of it. But so is tax strategy across multiple years and multiple entities. So is legal structure, the trusts, the LLCs, the holding companies that determine where your wealth lives and who can touch it. So is insurance and risk management, because at a certain point the thing that ends fortunes isn't a bad investment, it's a lawsuit nobody saw coming or a coverage gap in an umbrella policy that should have been reviewed 4 years ago. So is reporting, knowing at any given moment what you actually own, what it's worth, what it costs you, and how all of it fits together. So is governance, the rules a family sets for itself about how decisions get made, how the next generation gets prepared, how disagreements get resolved before they become the kind of thing that ends up in a courtroom with cousins on opposite sides. And yes, at a certain scale, so is lifestyle administration. The kind of operational weight that accumulates when you have multiple properties, multiple entities, staff, a calendar that could employ a small logistics company just to manage. All of that together is a family office. Most people have fragments of it and don't realize they're already building one. Now here's the myth. The one that costs people real money in real time because they believe it long after they should have let it go. The myth is that a family office is something you get at a number. That there is a dollar figure printed somewhere, 5 million, 25 million, 100 million, and the moment you cross it, you call a number and someone sets it up for you the way you turn on cable. That is not how this works. You don't receive a family office. You build capabilities as your complexity rises, and complexity is not the same as wealth. Complexity is illiquidity. It's a business you can't just sell on a Tuesday. It's multiple entities that file separately and interact in ways that require someone who understands all of them simultaneously. It's cross-border assets, a property in another country, income from a foreign partnership, a beneficiary who lives abroad. It's family members on payroll, children in the business, a spouse with different exposure. It's time scarcity, the point where your actual time, the hours in a day you have available to think about this, is worth more than whatever you'd pay someone to handle it. Those are the real triggers, not a number. A set of conditions that eventually demand a coordinated response instead of a stack of separate advisors who have never been in the same room together. Two people with $20 million can live completely different levels of complexity. One of them has liquid assets, a primary residence, a single brokerage account, straightforward taxes, one advisor who handles everything adequately. His life does not yet require the infrastructure. The other one has a partial stake in an operating business that isn't liquid, a rental portfolio with entity structures across 3 states, a trust set up when his estate plan was drafted 6 years ago that nobody has reviewed since, aging parents whose finances have quietly become his problem, and a calendar so compressed that he missed a refinancing window last fall simply because nobody flagged it in time. Same net worth, completely different answer to the question of what he needs. And then there is the cost reality, which is the part that tends to get skipped in conversations about this because it is uncomfortable and unsexy. Family offices are expensive to run. The fixed costs, staff, technology, legal and accounting, office infrastructure, don't care how your portfolio performed this year. They are there when the market is up and there when it isn't. A single family office at the institutional level can cost $2 to $5 million a year to operate before a single investment decision gets made. That overhead, that fixed drag on the portfolio, is the silent killer that turns what looks like a wealth management solution into a wealth management problem if the assets underneath it aren't large enough to absorb it without meaningfully reducing net returns. This is why the structure has to match the scale, and why knowing where you are on the ladder matters more than knowing the ladder exists. That is exactly what this is going to walk you through. 4 levels. Starting at the first 5 million, the point where most people have enough complexity to get themselves into real trouble but not enough to justify serious infrastructure, and climbing all the way to the 500 million institutional machine where the overhead is justified. the staff is real, and the risk has shifted from whether you can afford the structure to whether the structure has quietly started consuming more than it creates. Every level has a different answer to the same set of questions. What do you actually need? What can you outsource? What does it cost? And what happens if you get it wrong? The numbers change at every rung. The mistakes change. The options change. Start at the bottom and pay attention, because most people who end up at the top started making decisions down here that they couldn't undo later. So you're at 5 million, maybe 10. Maybe you just cleared 25 and you're starting to feel the weight of it, not in a bad way exactly, but in the way you feel the weight of a house the first winter you own one, when things start breaking and you realize nobody is coming to fix them unless you call someone. That's level 1. And the single most important thing to understand about it is this: your goal right now is not to optimize. Your goal is to stop bleeding. Because here's what actually happens at this level. You have money, real money, enough that the mistakes are no longer rounding errors. But you don't have a system. You have accounts. You have a CPA you call in March. You have an investment account someone set up for you, and a life insurance policy you haven't looked at since the agent bought you lunch. You have a will that was drafted when your oldest was 3 and hasn't been touched since. You have complexity scattered across 6 different relationships that have never spoken to each other, and somewhere in the gaps between them, things are falling through that are costing you more than you realize. The first thing you build at this level isn't a strategy. It's a baseline, a consolidated balance sheet. Everything you own, everything you owe, every entity, every account, every policy, every real asset, one document, one number, reviewed on a real schedule. Quarterly at minimum, not because the numbers change that fast, but because the act of reviewing forces you to notice what's drifting. Most people at this level have never seen all of their financial life on a single page at the same time. The first time they do, they find something, almost every time. Then you clean up the entities and the accounts. The LLC you formed 3 years ago that has a bank account with $4,000 in it and hasn't filed properly. The brokerage account you opened at a second firm for a reason you no longer remember. The joint account that has the wrong beneficiary designation because you set it up before you were married and never updated it. None of these are catastrophic on their own. Together, over time, they are the kind of slow administrative rot that turns a clean estate into a legal problem for someone you love. Now for the advisors. At this level, you need 3, and only 3 with real expertise. A CPA who does more than file your return. One who thinks about structure, about when to take income, about entity selection, about what next year looks like before next year arrives. An estate attorney who can actually explain why the trust they're drafting is structured the way it is and what happens if you die Tuesday. And an insurance specialist, not a generalist with a life insurance license, someone who reviews your full liability exposure and can explain specifically where you are uncovered right now. A financial advisor can make sense here too, but only if they're coordinating across the full picture, not just managing one account in isolation and calling it wealth management. On the investment side, the advice that almost nobody wants to hear at this level is to do less. Not because complexity is wrong in theory, but because complexity at this scale almost always costs more than it returns. A policy portfolio, meaning a simple, documented allocation you can actually stick to, paired with real liquidity buckets for near-term needs and a clear decision rule for alternatives. The decision rule matters more than the alternatives themselves. Before you write the check on any private deal, any fund, any structured product, you answer 3 questions. Do I understand exactly how I get my money back? What is the realistic worst case? And does this decision require me to know something I actually know, or am I just trusting someone who sounds confident? If you can't answer all 3 clearly, you don't do it. That rule alone would have saved more fortunes at this level than any particular investment strategy ever built. Risk management is the part that gets skipped because it isn't interesting. Umbrella coverage reviewed annually, not just renewed. Property and casualty coverage that reflects what you actually own now, not what you owned when you signed the original policy. Cyber coverage because at this net worth you are a target in ways that feel abstract until they aren't. And single point of failure scenarios, meaning you have actually asked yourself what happens if you are incapacitated for 6 months and the answer is written down somewhere your spouse or your attorney can find it. On the estate and tax side, the fundamentals matter more than the clever moves. Get the will done. Get the trust structure explained to you until you could explain it back. Understand your annual gifting guardrails before you start giving money away in ways that create problems you don't see for 7 years. And resist the urge to DIY the parts that look simple. The expensive mistakes at this level almost always come from someone who read enough to feel confident and not enough to know what they were missing. Which brings you to the traps because they are specific and they are predictable. Paying for prestige instead of competence, the firm with the beautiful offices and the name that sounds impressive, and the advisor who is managing too many accounts to actually think about yours. buying exotic products because someone made complexity sound like sophistication. And the quietest trap of all, confusing activity with strategy, the sense that if you are always doing something, always moving, you must be building something. Sometimes the most expensive thing you can do at this level is keep touching it. The whole point of level 1 is not to build an empire. It's to build the floor that makes everything above it possible without collapsing. You built the floor. Now the building starts getting heavy. At $25 million, something shifts that isn't just a number getting bigger. The complexity doesn't scale linearly. It doesn't double when your wealth doubles. It compounds in every direction at once. Suddenly you have multiple entities that need to coordinate. You have alternative investments with capital calls that arrive on their own schedule. You have family stakeholders, a spouse, maybe adult children, maybe aging parents, each with their own financial surface area. You have tax exposure in multiple states, possibly multiple countries. You have a real estate portfolio that needs its own attention. You have a philanthropic vehicle someone set up because it seemed like the right time, and now it needs to be governed. You have advisors who still aren't talking to each other. And you have decisions that require someone to own them, which means you need a structure, not a stack. The first real choice at this level is one of the most consequential you'll make. Do you join a multifamily office, or do you start building your own internal infrastructure? A multifamily office, or MFO, is exactly what it sounds like. A firm that serves as the operational and strategic hub for multiple wealthy families, consolidating investment management, tax planning, estate coordination, family governance, and reporting under one roof with shared overhead. The pitch is compelling. You get institutional-grade infrastructure, access to investment managers most individuals can't reach, a full team of specialists, and someone coordinating all of it without you having to hire and manage each piece yourself. For the right family at the right level, an MFO is genuinely excellent. For the wrong family at the wrong MFO, it is an expensive relationship that creates the feeling of sophistication without the substance. Here's how you pressure test it. The first question is compensation structure. How does the MFO make money? If the answer involves any allocation to proprietary products, any revenue sharing with investment managers, any incentive that is not purely and transparently tied to your outcomes, that is a conflict. Not necessarily a deal breaker, but one you need to understand completely before you sign anything. The second question is reporting. Can they show you exactly what you own, what it costs, what it's returning, and how it compares to relevant benchmarks in a format you can actually read on a real schedule? Weak reporting is usually where problems hide. The third question is access. Who actually works on your account? The partner who sold you the relationship or someone more junior you haven't met yet? Go find out before you commit. The alternative is building what some people call a virtual family office, an in-house infrastructure that coordinates a set of best-in-class external specialists under centralized direction. At this wealth level, you're not yet hiring a full single-family office staff. You're building something leaner, but you're starting to hire directly. The most important early hire is a CFO type or financial controller. Someone whose job is to own the consolidated picture, manage cash across entities, coordinate with your CPA and attorneys, prepare for quarterly reviews, and catch what falls through the gaps. This person is not your investment manager. They are your operator. Think of them the way Ellery's kind of wealth always has an invisible layer of people making it function without anyone ever seeing the machinery move. Around that person, you're outsourcing with intention. Tax lead who operates as a genuine strategic partner, not just a filing service. Legal coordination for entity maintenance, estate updates, and any transaction-level work. An investment advisor or investment committee structure that operates with a written investment policy, full stop. If there is no written investment policy, there is no strategy. There is just a series of individual decisions made by whoever happened to be in the room. Speaking of investment operations, at this level, you need real manager selection and diligence processes. Not casual due diligence, not trusting someone's track record because a respected person vouched for them at dinner. Actual documented processes for how you evaluate managers, how you monitor them, what triggers a review, and how you get out. Custody matters too. Who holds the assets? How segregated are they? And can you verify independently? These are not exciting questions. They are the questions that protect you from situations you do not want to be in. Tax strategy has to become a system now, not a conversation you have in February. Quarterly planning, entity optimization, charitable tools like donor-advised funds or charitable remainder trusts that can do real work if structured correctly. If you have presence in multiple states or any international exposure, that layer needs dedicated expertise because the default answer on state and country tax questions is almost always wrong for people at this wealth level. Then there's governance, which is the piece most people delay longest and regret most. A spending policy that defines how liquidity gets used and who approves what. approval thresholds for investments, capital commitments, and discretionary spending above a certain level. Rules around family employment, because the moment a family member is on the payroll is the moment you needed those rules in writing before it happened. And a regular decision-making cadence, a family finance meeting that happens on a real schedule with an agenda and minutes, not a holiday conversation that meanders into whether someone should sell their rental property. The red flags at this level are specific. Opaque fees buried in fund structures or manager relationships. Anyone pushing a product when you ask for advice. Reporting that makes your portfolio look good but doesn't let you actually see what's inside it. And the absence of a written investment policy statement, because that absence is almost always intentional. Someone benefits from you not having it. At $25 million to $150 million, the job is not to act like an institution. It's to build the habits of one. The families who arrive at the next level intact are not the ones who found the cleverest strategy. They're the ones who built systems early enough that the systems ran even when nobody was paying attention. Because at some point you will look away. The question is whether anything is holding when you do. There's a number somewhere between $150 million and $500 million where the math on running your own office finally closes. Not emotionally, not as a status move, not because having a staff with your family name on the door feels like a rival. The math actually closes. Fixed costs of a real single-family office, fully staffed, run between $3 million and $5 million a year when you add it up honestly. Salaries, benefits, technology, compliance, office space, audit, legal, and the dozen line items nobody mentions in the brochure. At $150 million, that's 2% to 3% of assets just to keep the lights on before a single investment decision gets made. That number has to earn its way. And it does, but only if the complexity you're managing actually justifies it. Privacy requirements that an MFO structure can't fully contain. Control over investment strategy that shared infrastructure won't accommodate. A volume and variety of decisions that genuinely requires dedicated people to hold it. If those conditions are real, you build. If they're not, you're buying a very expensive piece of architecture for a problem that didn't need it. Assume the conditions are real. Here's what the org chart actually needs to look like, and more importantly, what it doesn't. You need an executive director or chief of staff at the top, someone who runs the office operationally and reports directly to the principal family. Below that, the two hires that matter most are the CIO and the CFO. Chief Investment Officer owns strategy, manager relationships, portfolio construction, and the investment policy statement. Chief Financial Officer owns entity accounting, tax coordination, consolidated reporting, cash management, and the relationship with external auditors. These are not the same person. That separation matters more than almost any other structural decision you'll make. The controller sits under the CFO and owns day-to-day transaction recording, reconciliation, and making sure what the custodians say matches what your own books say. Tax sits either inside or as a deeply integrated external relationship, but either way it operates as a strategic function, not a filing service. Operations handles everything from vendor management to payroll to the lease on the office space. That's the core. Everything else, legal, compliance, family education, philanthropy, gets layered in as dedicated function or retained external specialists depending on volume and complexity. The failure mode here is elegant and quiet. Offices that start lean tend to drift. A hire here because someone left and you needed coverage. A role there because a family member needed a title. Redundancies accumulate slowly, every one of them justifiable in isolation, and the total cost number climbs in a direction nobody voted for. The discipline is to define what each role owns, who it reports to, and what getting rid of it would actually cost you before you make the hire. If you can't answer that cleanly, wait. Institutional grade process is what separates a single family office that functions from one that just exists. Your investment policy statement is not a formality. It is the document that tells everyone, including you, what you are actually trying to do, what risk you're willing to carry, what asset classes you'll use and won't, how you rebalance, and what triggers a manager review. Without it, every investment decision is a first principles debate. With it, most decisions are just execution. Manager reviews happen on a schedule, not when someone raises a concern. Rebalancing happens according to the policy, not according to how a family member feels about the equity market in November. Controls and audit aren't theater. They're the mechanism that catches the thing you didn't know to look for. Direct investing deserves its own honest conversation. At this level, families start getting access to direct deals, co-investments, operating company stakes, real estate developments, private credit opportunities with names attached to them that feel like proof of arrival. And most families overestimate their edge here in ways that are expensive to correct. The question isn't whether you have access. Access is table stakes at $200 million. The question is whether you have the sourcing relationships, the diligence infrastructure, the domain expertise, and the portfolio construction discipline to do it better than allocating to a managed fund run by people who do nothing else. If the honest answer is no in any of those areas, the fund is the better choice. The framework is simple. Only direct invest where you have a genuine, demonstrable, structural advantage that a fund cannot replicate. Everywhere else, pay the management fee and get back to what you're actually good at. Advanced planning at this level isn't a checkbox. Dynastic trusts structured for multi-generational transfer efficiency. Philanthropic strategy that operates with an investment policy of its own because a poorly governed foundation is just a slow leak with good PR. Family education for members who will one day inherit governance roles, because the families who fail at the third generation almost always failed at the education step, not the legal structure step. Succession planning for the family office itself, because key person risk inside the office is as dangerous as key person risk anywhere else. If the CIO walks out tomorrow, do you know where everything is? Can anyone else explain the portfolio? That's where the real failure modes live. Not in bad investments. In lifestyle creep inside the office where staff compensation and overhead quietly benchmarks against the family's wealth instead of the office's value creation. In misaligned incentives where people running the office benefit from complexity and activity rather than simplicity and outcomes. In governance breakdowns where the family's decision-making structure never got written down and now two siblings with different ideas about risk tolerance are both trying to run the CIO. The office itself can become the problem it was built to solve. An institution that consumes rather than compounds. The entire ladder comes down to one principle: build the minimum effective office for the complexity you actually have, not the one you want to be seen running. Match structure to substance. Everything else is just a very expensive coat that rearranges everything around it. If you want the frameworks to actually build this, templates, role checklists, IPS structure, manager review processes, subscribe and watch the next video. It's all there. The machinery Ellery never needed you to see.